2025 is the year when gold started front running what are inevitable developments in the dollar. I think that probably puts it in a nutshell. And it creates, if you like, the background for what we can see in 2026 and 2027. The geopolitics as well, the ups and downs of trade discussions, hardly discussions. I think that global trade has been screwed, really, by American policy, which has vacillated one way and the other. The relationship between America and China as well, I think, is a big, big topic. And it's led China, I think, to take some very serious decisions to protect its own resources. Its own resources being, we've got, silver. That she's stopped supplying silver automatically to the rest of the world, which was what was depressing prices of that. There is absolutely no doubt. So silver has taken off. And I think there's a growing realization that it's not just silver, but China is actually a major source, global source of processed rare earths, antimony, cobalt, all these things which are needed now. So the entire base metals sector or basket of them has actually begun to move up. So we're beginning to see inflation, which so far is not being discussed at all in monetary circles. And I think that is interesting. And I think it's irresponsible, actually, to just sit on that story, which is really what the Fed and other central banks have been doing, other G7 central banks. So quite a lot to talk about in that sense. But I think also we need to look forward to what's likely to develop in 2026 and 2027. The other thing is that particularly the Fed has given up on trying to control inflation. The official story is inflation is no longer a real problem. Okay, it's 50% above the desired level, but we're not worried about it. Therefore, we end quantitative tightening and to ensure there's ample liquidity in the system, we're going to start quantitative easing. I think actually that underneath it all, the Fed must be very, very concerned about the tech bubble, about that bursting, about the Bitcoin bubble, the consequences of that bursting. I don't know to what extent they take indications of the gold price going higher and silver price going higher and what that might mean. They've had all that, sort of sound money stuff drummed out of them, in effect. But I think they do actually see the US economy stagnating and therefore needing monetary support. Now, they're going about it completely the wrong way, but, it's irrelevant. That's the way they do it. So on that basis, I think, there is a big change, and it is going to be very, very inflationary. I think that's the key point to understand. Inflationary in the sense that, and I always prefer to look at it this way, inflationary in the sense that what will happen is that the dollar's purchasing power will decline a lot more than people think in 2026. So I think 2025 gives us the background to that.
China's recent moves signal a clear strategic pivot. By tightening exports of silver and exerting control over critical inputs, such as rare earths, cobalt, and processed base metals, Beijing has quietly reconfigured global supply chains. Industrial metal prices have already begun to reflect that shift. Yet inflation driven by resource scarcity is being largely ignored by Western central banks. The silence is telling. While policymakers insist inflation is under control, the underlying cost of physical materials continues to rise. This gap suggests a fixation on financial metrics rather than real-world supply constraints. That blind spot risks intensifying inflationary pressures, just as global demand for energy transition metals accelerates.
Well, I actually don't share the Fed's analysis on this. I think there is ample liquidity in the system. The problem is that banks are getting worried about extending credit. And so that's the real issue. And the idea of reducing interest rates and doing QT and therefore flooding the bank's balance sheets with the most liquid form of deposits possible, i.e. reserves at the Fed, is not going to be the solution. It really is not. Banks, I think, are, I mean, if you just listen to Jamie Dimon, what he's been saying, banks see this environment as being not at all friendly. And the other thing, of course, is that as far as the Treasury is concerned, they have a problem because the only debt that's really selling is very short-term debt, which actually tells us that global investors see the Fed sliding into a debt trap. I mean, you know, what's the right rate for a 10-year bond or a 30-year bond? I mean, you know, I know what the market's saying, but the market is, if you like, in a sort of stasis on this. But if the Treasury really tried to test it, I think you'd find that yields would start going up quite dramatically. Why? Because they reflect the risk, if you like, inherent in investing in long-term US Treasury bonds. Now, everything else takes its tune from that, including equities. What we've seen in US Treasuries is a consolidation phase from about 2022, after that very, very sharp rise, following the economy coming back post-COVID. It looks to me, I mean, there are signs that yields are breaking out higher. I mean, the Japanese yield is going higher, and Japan is, if you like, not being very helpful because with its bond yields rising, they are now getting sort of attractive to Japanese institutions, you know, the pension funds, insurance companies, and so on and so forth. I mean, the reason that they are the largest holders of US Treasuries is because they were getting superior returns there compared with domestic bond markets. Now that's changing. The gap is closing. Furthermore, with interest rates rising, and presumably we'll get a rise in Japanese rates in the next day or two, which is all discounted, admittedly. But with those rates rising, the carry trade is no longer so profitable. In other words, the return on the carry trade is no longer really sufficient to cover the currency risk. So putting the whole thing together, Besant at the US Treasury can see a problem down the line. So what will QE do? Well, QE basically, what will happen, I think, is that the Fed will be buying short-term T-bills in the market, which bolsters the reserves of the banks on its balance sheet, which looked another way from the bank's concern means that their deposits rise, and they will effectively take those deposits and use them to buy US Treasuries. So all this is about funding US Treasuries at the moment. I think that the real problem which we now face is that as these bond yields, the long end, begin rising again, that'll undermine the equity bubble. And we're already seeing the equity markets looking tired, let's put it that way. And when that bubble pops, I think the damage will be enormous. What you will have, and I don't know, I mean, the timing of this, it could be by the year end, it could be by, say, the end of March, that sort of period. But the timing on this, I think, means that the bubble, when the bubble pops, you'll find that banks have stock as collateral. They will sell those stocks in order to secure the value of their loans against them. So you're going to get a massive selling from the system, which so far has been pumping in funds into stocks. And at the same time, foreigners will try and run a mile. I mean, they've got over 20 trillion invested in US equities at the moment. And when they see the market begin to crash, they will go. And so that's a big source of selling. I think they'll probably only get out with less than 10 trillion, personally. I think they'll probably only get out with 5 trillion. They're going to lose a lot of money. And they understand this. As soon as the bubble pops, they're out. They're going to try and get out, and that's going to crash the market. So I see this happening in the not too distant future, and anyone who is invested in equities better watch out. And I think the other side of that is that because it's all connected into, the financial system, this sort of crisis means that the Fed will be trying to, if you like, ensure the entire financial system doesn't go under. So they're going to be doing QE not just to finance the US Treasury, but they'll be doing it to try and support financial asset values. And the other thing that I think we're seeing, and this is a slight sideshow at the moment, is that soaring silver, if it continues, could well, if you like, raise questions about counterparty risk in derivatives markets. And this is particularly the case for London, which is an OTC market. And I think on that basis, if you've got a counterparty risk problem developing in derivative markets, then that's going to spread not just from silver, but into gold, into other commodity contracts. And because all the operators in those markets, those derivative markets, deal in everything else, whether it's interest rate swaps, whether it's currency swaps, whatever, all those things, then they're going to be questioned. I mean, we're, if you like, rather on the edge of a precipice looking down into a chasm. That's where we are. And people who don't understand this are going to get caught. I mean, very, very seriously.
Officially, inflation is said to be under control. In reality, it remains well above target. Central banks have responded by loosening policy once again, choosing liquidity over restraint. The true fear isn't inflation itself, but financial instability, especially overstretched technology stocks and speculative assets. Rather than allowing markets to reset, policymakers are opting for support at any cost. The consequence is a growing reliance on monetary expansion. While this may steady markets in the short term, it steadily corrodes purchasing power. In this sense, inflation isn't simply rising prices. It's the quiet, ongoing erosion of currency value, largely
I mean, where else does JP Morgan go is the answer. They've also, I don't know how far it's got, but they're also changing the rules, for the amount of capital that large banks hold. Now, if they invest in UST bonds, then the argument goes that that is the most superior form of asset on a bank's balance sheet, and therefore it doesn't need to have the extra capital required under Basel III for very large banks with international business. So, I mean, the US Treasury is trying to create a situation whereby it can continue to fund itself. And this is, it all amounts, I think, to desperation. Absolutely. And of course, the other thing, Anthony, if I can sort of just take that a little bit further, is you have to ask yourself why it is that these banks are not prepared to extend credit to, the private sector, the real economy. I mean, they just see bad debts there. They're beginning to see the economy, the fact that the economy has been stagnating is something which I've been aware of. I'm sure they have been aware of for some time, but there are now signs with unemployment rising and all the rest of it that is, deteriorating into a recession.
The bond market is flashing warning signs. Investors are crowding into short-term government debt while steering clear of long-dated bonds that carry greater inflation and fiscal risk. That shift signals deepening doubt about long-term stability. Rising yields, particularly in Japan, are now starting to unwind decades-old capital flows that once helped support U.S. debt markets. As yields rise, equity valuations become increasingly difficult to defend. Banks, sensing growing credit risk, are tightening lending to the real economy. Liquidity may still be present, but confidence is not. The result is a fragile equilibrium, where financial stress is quietly building beneath markets that appear calm on the surface.
No, well, Europe is definitely, Europe's got different problems, and of course Britain has too. I mean, the governorship of the EU is failing completely. I mean, it's a complete failure. And in the UK, we've got a government that's got absolutely clueless. It's pursuing, classroom socialism. I mean, these guys know nothing at all, and they're just destroying the economy. So yeah, I mean, we do have, very bad problems in Europe, and that's something which, I mean, basically the whole system will fall over when America falls over. I think that's the key to understanding it, because those in power in Europe, and the other thing is that, in terms of geopolitics, they've completely lost the plot. They almost need to cast Russia as evil in order to protect their own positions, which is bad. It's very, very bad. And the intelligence services are pandering to their political masters, telling them what they want to know. Yeah, the Russians are evil, etc., etc. They're doing this, they're doing that. We've got to defend ourselves, and we've got to go and defend Ukraine. I mean, Europe is a mess. Europe is basically bust. But so is America. I mean, what we have is we have a system which is based on the dollar, and when the dollar goes, the rest is going to fall like a pack of cards. Now, you mentioned China. China actually is in a very different position, because China understands that this is happening and has understood it for a long, long time, which is why they have been buying gold, which, more correctly put, which is why they have been selling dollars and also selling euros. I mean, they have a policy of reducing their exposure to G7 currencies as much as they practicably can. And not only that, but they're putting in provisions to protect themselves from the complete wipeout of the dollar. That is why the Shanghai Gold Exchange is opening vaults, or has opened vaults in Hong Kong and also Saudi Arabia. And at some stage, I have absolutely no doubt that for trade settlement purposes between BRICS members and Shanghai Cooperation members and China, whatever, and Russia, she plans for the yuan to replace the dollar in a new sort of Bretton Woods version 2. She doesn't want to get out of gold, but she's got very substantial gold reserves. Of that, I'm convinced. And she's got a plan to protect herself. Now, she won't, I think, anticipate events in the sense that announce a gold standard tomorrow. She will only do so when it is absolutely clear to the world that she needs to put it on a gold standard, the yuan onto a gold standard, in order to protect herself from a collapsing dollar. And I think that's something we're going to see maybe in the second half of 2026. And that's going to make the situation even worse for the dollar. And you've got to ask yourself, how do the Americans respond to that? Well, under the current, in fact, I mean, it doesn't matter who the president is. They are not prepared to go back onto a gold standard, to make the cuts in public spending, public sector spending, necessary to balance the budgets and produce a surplus, and to withdraw from interfering in the underlying economy. Nobody's prepared to do that. Europe, I mean, even less so. So, unless there is a change in that, and that's my only single caveat, something I can't see at the moment, unless there's a change in that, I'm afraid the dollar and the euro are going to zero, and sterling for that matter. Zero. So if people who want a forecast for the gold price, you won't get a forecast from me. But what I will tell you, that forecasts are completely irrelevant, and the collapse in the currencies will drive the exchange rate between those currencies and gold. So that gold,
if equity markets were to turn sharply lower, the fallout could be severe. Stocks are widely used as collateral, so a downturn would likely trigger forced selling, accelerating losses. Foreign investors holding trillions of dollars in U.S. equities could rush for the exits, amplifying volatility. Meanwhile, Rising prices in silver and other commodities are already raising concerns about derivative exposure and counterparty risk, especially in opaque over-the-counter markets. Stress in one asset class rarely remains contained. When confidence erodes, it ripples through credit, commodities, and currencies alike. In a system this complex, even localized shocks carry a high risk of cascading into full-scale systemic events.
Well, in 2026, gold will continue to front run a collapsing dollar. I think the big surprise for everybody will be the degree of inflation, which is the consequence of a collapsing value for the dollar. You then ask yourself, what does the Fed do about it? It can't do anything. It's actually trapped. That we're seeing the end of the fiat currency system. That's really what it amounts to. And I think that'll become a lot more obvious to a few of us in 2026. As far as the wider public is concerned, if the dollar survives into 2027, they will finally realize there's not prices going up, the dollar going down. And therefore, they will start dumping the dollar. They will start dumping any liquidity they've got in return for goods, whether they need them or not. Flight into real goods, if you like, is the death throw for any fiat currency. And I think sometime in 26, maybe into 27,
China has spent years preparing for this moment, cutting its exposure to Western currencies, expanding its gold infrastructure, and building alternative trade settlement systems. It is positioning itself for a post-dollar world. A future shift toward gold-backed trade mechanisms would accelerate global de-dollarization. Western governments, constrained by massive debt and political realities, are unlikely to respond with fiscal discipline or meaningful sound money reforms. As confidence erodes, populations eventually abandon paper currencies in favor of real assets. History shows this is the final stage of fiat decline. Gold doesn't rise, currencies fall, and that realization may define the years ahead.